Hello and welcome to Blockchain Gaming World Daily with me, Jon Jordan. So I'm going behind the scenes a bit back to my my lovely Google spreadsheet, and today we're going to be looking at some kind of very basic research, really, but some research I'm doing based around mergers and acquisitions in the blockchain game space. So M&A, as we call it, mergers and acquisitions, is when obviously acquisition is when one company buys another company, and mergers, kind of less common now, is when kind of companies merge together. And so this is just a way of, well known in the corporate financial world, of looking at how kind of market sectors develop. What generally happens is a new sector develops, it's all very exciting, loads of VC money is pumped in, loads of companies start off, loads of startups, all have great ideas about how they're going to be the next unicorn, the next billion-dollar company, and then over time, some of them start to run out of money, some of them gain more success, and they start buying up all the other companies. And you basically start to see this consolidation. That's roughly what happens. It happens in different phases. So every sector has a different sort of kind of dynamic and a different sort of timescale, but this is generally what we see. So I'm trying to have a look around what's going on with blockchain games. Very early at the moment, I would say. So we're not seeing a lot of acquisitions. We are seeing quite a lot of investment going in. So I've done some work around the investments going into blockchain games, but not so much acquisitions at the moment. But there is one company in particular that is acquisitioning, that is buying other companies like crazy. So it's kind of worth having a look from that point of view. This is my basic starting sheet. I've not really spent a lot of time at all looking at all the deals. This is a very kind of first pass sort of thing. But what I'm looking at here is on this spreadsheet is so obviously the date, the company who was buying, the percentage of ownership that they gained when they purchased, and the company that sold. So as you can see here, very clearly, ANIMOCA Brands, which is a kind of a historically a mobile game developer and publisher based out of Hong Kong, was floated on the Australian Stock Exchange. Is now, I think, going to float in Europe, or is planning to float in Europe. And it's been doing a lot of the or vast majority of acquisitions. One of the reasons it can do that is, as an existing company, it has access to money. And as we'll see at the moment, it's been kind of quite clever in, or sensible, really, not clever, but because it's has been a floated company, it can kind of use its shares as leverage, and then it can buy other companies, not using a lot of cash, but using its shares. Because obviously it's investing so heavily into blockchain, so it still does some mobile game stuff, but it's pretty much transitioning into blockchain. That's where it sees the future. So it's pretty much going all in on blockchain gaming, or blockchain consumer products in particular. So it's using its share price to say to other companies, our share price is going to be worth a lot more in future. You don't want cash now, do you? We'll give you a really good deal for our shares. So that's kind of the dynamic of what we're seeing. So we can see it's kind of started out 2018. We had the first kind of there were some other deals before then, smaller ones, but the first big one we have here is Pixowl, who are the developer of the Sandbox. And what I've just done here, I mean, don't worry all this kind of junk, but so how deals are normally structured is you can buy companies with cash or shares or an option thereof. And that gives us the deal value here. So that's just in this case, say ANIMOCA Brands' most recent deal was a company called Gamey, and it bought them, valued them at $4.53 million. But it did that valuation was in shares, so it just gave them, it paid for Gamey with a load of its shares that were worth that much money at the time. Obviously, those shares will go up and down in value, and with these kind of share deals as well, the owners of Gamey can't just sell all those shares straight away. That they have lock-in periods. So I think normally you have at least a 12-month lock-in period and probably 20 months, 24 months, or a 2-year lock-in period, and so they can't sell all those shares at once. And I think often in the contract it has, you can only sell a certain amount of shares. You can't just dump them all on the market. You can potentially sell like 10% of the general market volume at any one period of time. So obviously, what you don't want is to buy a load of companies with shares, and then a year later, that all these companies will dump all their shares on the market and tank your share price. So, so the main thing we can see here is basically ANIMOCA Brands is buying most of these companies with its own shares. So, if I look at all these deals, $21.4 million worth of value has been acquired by ANIMOCA Brands using its shares. It's been very, very tight on cash. So, it has spent $2.6 million of cash. Actually, a little bit more than that. There's always kind of weird things around deals. So, in the case of Pixel, the two founders of Pixel got paid $100,000 each as a signing fee, which kind of probably should be part of the cash deal. But by the by, there's always these little kind of details. Basically, we can see the cash there, and then we can see the total deal value. So, ANIMOCA Brands to date has acquired companies with in deals valued $24 million. This is all US dollars, by the way. Now, the other thing to look at is what we call earn-out. So earn-out is here. An earn-out is something like a performance total that you give to companies when you buy them. And you basically say, if you do really well over the next year, you'll get a bit more money. And sometimes it's if you do really well over the next year, you'll get a bit more money. If you do really well over the next 2 years, you get even more money. So this is kind of potential earn-out. So this doesn't really matter in the sense that if these companies don't do really well, then they don't get this money. And if they do really well, ANIMOCA Brands, as the owner, gets the majority of that money. So this is, in a sense, kind of future money that is kind of good incentive for the founders of the company, people who are still working there. But this is not really a cost to ANIMOCA. And this often as well is split between cash and shares. You can see here in the case of Pixel, the earnout is defined as being this many shares. This gives us the potential. So all these deals might eventually be worth $35.3 million. So that gives us kind of all that. What's interesting to say in this case as well as when ANIMOCA Brands has been doing all these deals, it's also been raising money. So ANIMOCA Brands in the process has also raised $10.5 million. $10.5 million worth of cash to kind of fund the acquisition and the running of these companies. So that's worth looking at. Often the case is, interestingly, with a lot of these companies, or with some of these companies are not actually profitable. So because they're not profitable, ANIMOCA Brands gets them at a cheaper rate, but also it needs to inject cash into them to keep them going. So in particular, I think this company, Enway, who they bought, actually the deal's just shut now, that company was loss-making. So ANIMOCA Brands, as part of the deal, said they were going to inject cash, kind of operating cash, into the company because the company was doing a lot of investment into a new platform. So again, that's not reflected here. I've tried to make it as simple as possible while capturing the most data. So that's kind of interesting. You can see the only other deal that we've had here is Gemini, the Winklevoss brothers, twins. They bought a company called Nifty Gateway. We don't know. They didn't release the price of that, so that's not very helpful. But I put it in there for those reasons. And one other very small case here, we can see ANIMOCA Brands normally buys 100% of the company. In this case, Skytree, a Hong Kong mobile game developer, only bought 75%. So 25% of the company still remains with the original owners, but obviously 75% is a majority, so that doesn't really matter. Let's have a quick look at what it looks like graphically. Okay, so we can have a look at this data graphically. Sometimes it's a bit easier to conceptualize what's going on here. So this is actually in chronological order. So Pixel was the earliest deal that we're looking at. And we can kind of see in dark blue here we have cash, so we can see some of these deals are not cash deals at all. The most cash, so 2.6 million in cash. The vast majority of that was in the Enway purchase. Enway is actually one of the more established of these companies, so that kind of makes sense. That they probably have better negotiating terms. So if you're negotiating if you're selling a company, you don't really want shares, you want cash because you don't know what the share price is going to be in future. But cash, you can even if you don't get it all in one go, you can put that in your bank account and know that $1 million is $1 million rather than $1 million worth of shares, which may go up, may go down. So you can see here with Pixel, we can see the earnout again is in yellow. So with Pixel, because that earnout is actually in shares, I've estimated it. So that's probably, looking at the share price of ANIMOCA Brands over the past year, that's what this value is. It could obviously go up or down depending. We can see here now it's very clear, which are the big deals and which aren't. So Enway is the biggest deal, so potentially it's getting on for kind of over, it's like getting on for $9 million. Not a massive deal in the big scheme of things, but a potentially a big deal. And this is what the more established company. Pixel also established. Skytree pretty small, Striking again like a startup really. So a pretty small deal, although with a decent earnout. So he's kind of 2/3 of that deal value is based on earnout. Gamma, again, this was a very small startup, massively loss-making. Does kind of desktop mining. It's kind of interesting, but you can see here very little paid for it, but a big earnout if they can hit some high performance levels. Quid, again, another kind of startup, VC funded. I don't think it's profitable, but is generating revenue. And we can see so there's a reasonable amount of money paid for it in terms of shares, but quite a big chunk of earnout. In fact, that's the biggest earnout of all these $3 million if they can hit some targets there. And the final one, kind of Gamey, which is actually a fairly decent kind of price on the shares. Gamey is actually quite an established company, it's profitable. So it's kind of interesting that deal wasn't quite as high as maybe it would have appeared from Gamey's overall financial performance. So anyway, just a kind of a way of looking at what ANIMOCA Brands is doing. It is pretty interesting company. It is very aggressive into investing. It's pretty much looking at every blockchain games company as far as I can tell, kind of kicking the tires, looking to see can it make a deal. It's finding it quite easy to generate money. Either by raising from its own investors. It is attached to some very high net worth individuals, particularly out of Hong Kong, but also globally, kind of well integrated into the general game sector, and is raising money through issuing new shares. And that gives it quite a lot of muscle in this scenario, particularly because we're so early in the blockchain game space. Many of these companies, I don't think any of these companies are generating money from blockchain at the moment. This is another thing to point out. So none of these are currently. So Striking was the one doing blockchain, and Pixel had announced the sandbox, but they're not really generating ongoing revenue from them. Maybe from some pre-sales. But these all have potential to have blockchain elements as part of them. So Enway is doing a competitive kind of reward system, peer-to-peer kind of marketplace that is designed to use blockchain. Quid is a digital marketplace, not using blockchain, but obviously could use blockchain. Gamey is HTML5 gaming, which obviously means you can do browser games and actually games on kind of messenger, kind of mobile social media kind of apps. And again, you're not going through app stores, so much more flexibility to use things like blockchain. So all these companies, even if they're not directly involved in blockchain, ANIMOCA Brands thinks it can kind of get blockchain into them, and it thinks some of these are going to will be the first kind of the wave of big blockchain games in the future. So it has spent a reasonable amount of money. It obviously thinks it's going to be much more valuable in terms of hundreds of millions of dollars. That's why it's doing these investments now. So just a nice way of looking at it. Obviously, we'll be keeping an eye on these acquisitions as they continue. I know that behind the scenes, there's quite a lot of activity going on. ANIMOCA Brands is nice to look at because it's so public about what it's doing. Not all companies, as we saw with kind of the Nifty Gateway deal, private companies don't have to announce anything. It's only really public companies who need to really show all the details. Anyway, thanks for watching. If you're interested in blockchain games and the blockchain game sector, please do subscribe to the channel. We spend a lot of time looking at the numbers and trying to see what's going on. So if that's your thing, do subscribe. But thanks for watching this video, and hope to see you again soon.